Broker Daily Uncut.
Broker Daily Uncut.
News, views and opinion about what's shaping Australia's mortgage and finance industry.
Welcome back to another episode of Broker Daily Uncut. Joining me today, as always, is Costa Arvanitopoulos. But in lieu of either this week, we have another Finni broker, Robert Lee. Robert, welcome to the show.
Thank you. Thank you for having me.
How are you guys this week? How's your weekend been?
Yeah, good. It was busy. I had yesterday off, so got to enjoy that. But yeah, ready to go back into it. Go through all those emails.
Yeah, I gave up to you just before the podcast and it didn't look that fun in the inbox.
No, there was a lot of unread ones, so it's going to be a busy day.
Well, as the weekend's gone, obviously we're seeing a lot of movement. A lot of things have happened this week regarding fraud, regarding obviously the ever-moving market, and of course a variety of other things that we're going to be unpacking today. But I want to start quickly with auction results. Now, they're still looking a bit subdued, it seems. Costa, what have you seen there?
Yeah, well, these are just the preliminary results. Mm-hmm. So by today, tomorrow, they probably would have reduced. But for what they are now, we've got Sydney at 54%, Melbourne 57%, Brisbane and Perth at 60%. Now, to dissect that, anything under 60% is usually a buyer's market. Yeah. And anything over that is usually a seller's market. So I think we're now starting to see the effect of the higher interest rates, the cost of living, and just, those two factors mainly are just really putting people on the edge at the moment going, can I afford this? What's coming up? Obviously, the whole thing in the Middle East where fuel prices are only going to go up and we all need fuel for our cars. Yeah. And they're doubling. And then that relates into food prices going up. So everything is going up. And if you've got $1 million loan, do you really want to add another $1 million or $500,000 onto that? And then, your yearly spend has pumped up, $20,000. And that's a lot of money. And that's after tax as well. So it's a bit of a volatile market at the moment. There's a lot happening. And I think a lot of buyers are just sort of waiting to see what goes on.
And now, in your experience, do you kind of see, obviously we've had Easter, we've had a variety of things. Is there any kind of material reasons why this would be down, or is it purely market context that's causing this right now?
Yeah, I just think higher interest rates, cost of living. Listen, the week before Easter was much lower and that was understandable, but it's 2 weeks after Easter now. In the end, if you're looking for a home, you're sort of looking for a home. There's a lot of properties on market, so there's plenty there. It's not like they're restricting to wait till after Easter. But yeah, I just think sort of the whole cost of living, higher interest rates, and they're only going to go up. We've spoken on the podcast for the past few weeks that the banks are increasing interest rates again, so they're expecting another rate rise to come. So it's only going to go up.
But on that note, and Robert, I'd be interested to know what you think here. So obviously you're kind of seeing, we've talked on this podcast before about this kind of dual speed market that, we see these kind of figures come through, but then obviously Finni works predominantly with investors, but a variety of clients. What are you kind of seeing in your day-to-day conversations? Are you seeing your clients wanting to hold back at all?
So there is the consumer sentiment that people are, I guess, because of geopolitical matters that's going around in the Middle East, that people are holding back just to see how that pans out. But because also with the some of the major banks predict that there's going to be potentially maybe 2 or 3 more rate rises, which drive up their serviceability as well. Because we can see with the 2 rate rises already, it's already reduced some individuals' borrowing capacity by 24,000.
Yeah.
So in that sense, is that if there's going to be another 1 or another 2, that's about maybe 54,000 per based on their borrowing capacity. So with that in mind, I see a lot of people looking at other places other than Sydney or Melbourne, just because they still want to get into the market, but they want to get something that's within their price range, or in terms of their affordability or their serviceability. So there are still people that's buying, but there are also people that's still holding back just to see how things pan out. In the Middle East.
Yeah, it's always the same thing of like, should I jump or should I wait?
Well, we say a lot markets within markets. I was reading that the higher sort of end of the market has suffered more than sort of your middle than your lower end. So, that's just an overall picture of what these cities are doing. But there is always markets within markets. And we've touched on this quite a bit, is the first home buyers. So that sort of part of the market, which is on the lower end, is actually going up. So I guess it depends on where you are and how much stock is available, but overall it is reducing.
And speaking from that kind of investor side, like I'd love to hear, kind of your experiences here. As an investor, you kind of look at those auction results and you kind of think, well, there is a decent amount there for me to kind of look at, and there's deals to be made. I know we've talked, as you said, markets within markets. Is that a conversation that you're seeing kind of investors play out in the kind of investor market of, that there is potentially more, not more choice, but more kind of options, more ability to kind of make deals? Is that something that's coming in now, or?
Yeah, listen, a lot of the clients that I deal with, not too many go to properties that go for auction. So in that regards, not so much. But again, if we're talking about, doing deals and sort of getting a reduction in the purchase price, I have seen that. That's becoming more common. Listen, it's not, massive percentages, but it is a smaller percentage. And again, I'll use the client that I have in Melbourne who got 110 grand off a property in Preston's.
Yeah.
But that was a steal, that one. But yeah, I am seeing clients get a bit of a discount, but nothing too significant like that one in Melbourne. But yeah, like they're not really targeting the auction market, which I would assume is probably more owner-occupier compared to investor. And the regional areas aren't really doing many auctions where a lot of investors are going for those high-yielding properties and bigger returns. So that's from my side of my clientele.
Yeah, absolutely. And that kind of brings me on to something that I've seen, a piece of research that I found very, very interesting. Kind of looking at something a little bit different now. So a bit of data came across my desk the other day that basically looks at how Australians are really moving in the property market. So this isn't just about prices. It's about whether people are kind of upgrading or downgrading in terms of the price, in terms of the value of their homes. So it kind of looks at 250,000 moves between 2020 and 2025. And the key metric is the property ladder gap. It's something that I found quite interesting because it kind of brings a lot of these kind of aspects together and looks at it across the capital city. So basically the difference between people moving into higher value homes versus lower value ones. And what it shows is that the 5 capital cities have kind of behaved very differently throughout each kind of interest rate cycle that we've seen in this last. Obviously, we've seen a lot of movements in the last kind of 6 years. And I would love to hear, your experiences there. So I'd love to unpack some of the more stark kind of findings of this data. So, for instance, one of the key takeaways is Melbourne is the only Australian capital where the coefficient, the value of home, people are moving upwards constantly on every quarter in the last 6 years. Now, obviously, there's a lot of different reasons why that might be. It's as the only city that never broke, not once in the 6 years. Through COVID, rate hikes, cuts, what do you kind of see there? Is that a structural resilience? Like where do you think that is? And does that fit with your own experience with working with property in Melbourne?
When you sent this across to me after reading it, and again, as you said, Melbourne is the one that hasn't broken, which to a point doesn't surprise me because it has been the one that really has suffered through sort of COVID, and the property market there has it's had a lot of challenges with new taxes and this and that they've done there. I think it's a good time if you are a resident in Melbourne where you can upgrade and purchase a bigger home at, I wouldn't say a discounted price, but a fair price.
Yeah.
If you look at Sydney, I think there was one quarter where they were minus 4.6 or something like that.
Quarter 4, yeah.
And in Sydney, it's a very expensive city to purchase. So to upgrade your property in Sydney is very, very hard. It's not easy. We all live in Sydney, so we all know what that is, what that's like, sorry. So when I first heard it, I was wondering, like, why Melbourne? But when you sort of start unpacking the data, it doesn't surprise me.
Yeah.
And Sydney being on the opposite end of the spectrum where it is really hard to upgrade because,
But it's still a tale of two cities, right? It's quite interesting. So Melbourne and Sydney are often two cities that are kind of flagged for slowing price growth, they're flagged for a market that's kind of changing while, some of the other capital cities are surging ahead. And you can see, and this is why I found this metric quite interesting, is you can kind of see that there's reasons for and against why people would downgrade in that kind of market, right? So or upgrade. So in Melbourne, you might say house prices are starting to flatten, so people do have the ability more and more to kind of chase those kind of upgrades. But then in Sydney, that's not the case. So what's happening there?
Well, Sydney, you can if you're going to downsize, you're going to get a pretty good price for your house.
Mm-hmm.
And then if you're sort of like in that boomer sort of stage where you're going to sell and then downgrade, it's a good time to buy because you've got a solid home, single dwelling on a big block of land, which is very rare in Sydney at the moment. So you can sell, make $3-4 million and then purchase a property, an apartment, and downsize at $2 million. And then you got, apartment, live in, not much to do, and you got $2 million in your pocket. So that doesn't surprise me either if you want to look at that metric. I don't know. What do you reckon, Rob? That's sort of...
So just even just come back to the auction results that you mentioned earlier, and also just Julian, just regarding these results that you've gathered here as well for the 6 years. In 2024, there was actually no rate rises during that quarter, and if we look at the auction results, even what you mentioned earlier on as well, Costa, is that with the rates going up as well, people are still hesitant in terms of clearing or purchasing properties in Sydney. So it really goes to show that either investors or owner-occupied, they're mostly looking at other states. Yeah. And Sydney is probably the last one they'll probably consider because obviously whether it's the purchase price or it's just affordability. So I think it's definitely a state that only if you've got a significant of cash flow or serviceability, that's the last market that you'll probably consider to really grow your portfolio.
Yeah, absolutely. And I think that's why I found this data quite interesting, because another one that I wanted to bring out, I should also mention that this data is from findamover.com.au. So one of the other ones I thought was really interesting, we talk a lot about Perth, about WA, and about how house prices there are always going higher, the supply issues, all the different things. But that doesn't necessarily translate to consistent kind of upgrading, so to speak. And obviously you can see there's obviously material and
you've had a
factors
flood
why.
of investors going to Perth.
Yeah.
So are they upgrading, or are there just a lot of people from out of state purchasing up?
Yeah, and that kind of skews the kind of the data there. It's kind of seen this kind of peaks and troughs rather consistency. So plus 14% in 2020 Q3, plus 13 kind of moving forward, but then it's kind of lost its kind of momentum in terms of this is upgrading, remember?
Yeah.
With its hike peak average at 4.3 more recently. Still the strongest city of any of that period, but you're also seeing kind of 7 negative quarters as well. So those are people within the state that are downgrading. So it's not people moving in, but you're still seeing it. The only other city that took a worse reading than that is Adelaide. So what's happening there? I guess it's those variety of kind of material factors. Obviously, supply constraints as well. Maybe.
Yeah, I've always struggled with Adelaide as a city in regards to understanding how things work there.
Yeah.
That's just me. But yeah, like I always see mixed data coming out of that state. So I struggle to understand what's really going on there. I guess because I'm not there physically and I can't see it day to day. But yeah, Adelaide,
do you see any investor activity there? Are you talking to investors that are kind of interested in buying as much?
I'm seeing a lot in Victoria at the moment. A lot of our clients are going there. A lot of buyers agents are sort of keen on there. The Geelong region, Morning Peninsula, places around there. But yeah, Adelaide, not so much anymore.
Interesting. Well, guys, we better take a quick break there. Back in a sec. Welcome back. Broker Daily Uncut. Now, we've just been unpacking kind of the peaks and troughs of the Australian housing market, but something that's kind of hit closer to the home of the industry has been mortgage fraud. Now, we've talked a lot on mortgage fraud. Obviously, there was a alleged case involving CBA last month. I think it was last month, $1 billion or so. Obviously, that's still ongoing. But, as one kind of dips, another one comes up, which now is re-emerging in the lending sector. Brokers are speaking out about their experiences and stuff. But the aggregation group Finni may be implicated in allegations relating to a suspected fraudulent loan applications. This came kind of from an opinion piece in the Australian Financial Review. I think it was on 10th of April, where basically someone had come to the writer of this piece saying that two banks had come saying that individuals within Finni's network may have been involved in fraudulent home loan activity. Now, obviously, it's important to stress, and we've talked a lot on this podcast about this in the past, that this is always a very small amount of brokers, and that no industry is ever going to have a complete clean slate. But I spent a bit of time chatting with brokers yesterday about this, and they kind of felt that it only takes one or two to kind of tar the industry, and it kind of creates that kind of a few issues there. And obviously Simon Bednar, the CEO of Finni, kind of addressed those head on when talking to the advisor last week as well. But I wanted to get you guys' opinions and you guys' views, not just on kind of fraud from brokers, but fraud involving brokers where you may be inadvertently involved in a case and the potential repercussions there, but also how that can be solved. So let's kind of start off with the kind of story there, Costa. What was your kind of initial reactions to it when you saw it?
Yeah, as you were mentioning in the intro, every industry, regardless of what it is, has that small minority of people that are going to try to, I guess you can say, this term, rig the system. Mm-hmm. In this scenario, I used to work for a company that our aggregator was Finni, and they're very, very light on compliance. Mm-hmm. When I moved to Finni, and we're with Connective, very heavy on compliance. And I think that sort of, again, these are all assumptions and whatnot, but I guess that allows for it to fester and to make it easier when you sort of don't have those strict rules in place. It gives you avenues to get around certain things. So, yeah, listen, is it the first person case that we've heard? No. Will it be the last? Definitely not.
No.
But I think it all comes down to a more of a strict compliance issue, because the more compliance that you have, the more chance that you have of stamping this out.
Yeah.
Because there's less avenues, as I mentioned before, less avenues where this can happen. So it'd be interesting to see what happens when we do get some more information about it as well as time goes on. But yeah, it's not a good look as well.
Yeah, absolutely. And obviously, I think that these are the kind of headline statistics. Speaking of Connective, I interviewed Daniel O a couple of weeks back about this very issue, and he kind of noted that Connective had pretty low instances of genuine direct fraud in their broker channel. He kind of said as well that, do you know what, he thinks that competitors are probably incredibly low as well. The reality is that these kind of news grabs, they grab headlines, right?
Yeah.
But is it really, when you talk about the tens of thousands of brokers out there, is it really like a significant thing? However, what I think, in my conversations with brokers at least, is significant is the growing kind of indirect concerns around, could brokers be inadvertently submitting a fraudulent document, and what are the kind of repercussions there? So, Robert, have you ever kind of picked up on fraudulent? Obviously, I always find it interesting because there's kind of this grey area, the sliding scale. We talked about this before of, from one end of kind of fudging a small amount of your expenses or that kind of thing versus full-blown, AI generating payslips and stuff. But in that kind of spectrum, do you experience this?
Yeah, I think as a mortgage broker or even just working at a bank, you do see these kind of things that happens quite frequently as well. It's just that it's almost a numbers game. So they'll try this broker. If this broker doesn't actually comply or doesn't cooperate with them, they'll go to another broker. And there's always going to be someone that's going to try to see if they can slip through the radar. And just speaking what Costa was mentioning in terms of the other aggregator, I was with another aggregator as well before joining Finni too. They're also light with in terms of their compliance. So the supporting documents that we needed to comply to meet the aggregate standard was very limited compared to Connective. And even with that as well, we knew what we needed to get. So, and also what the banks needed to meet their standards as well. And so the individual or the client knew exactly what to provide or what they didn't need to provide. So in other words, sometimes they could actually turn a blind eye. And I think in this case here, it does make headlines, but again, at the same time, there's over 4,000 Finsure brokers, and and there's only a small percentage that, and it could happen with any aggregator as well.
Yeah.
But because obviously they pretty much have been, I guess, outlined in AFR, which obviously it's going to be under investigation for quite some time.
Yeah.
Along with CBA still under investigation as well, which makes it, I guess, daunting more for the aggregator to potentially change their policy or change the way they look at their compliance as well, or the compliance team.
Absolutely, and obviously, as you say, like these things are going to take a long time to come through the woodwork and see what the full extent lies. I remember with the CBA one, it seemed that the as of the minor amounts of information, the small amounts of information we have right now, that the amount of brokers implicated is quite low. And as you say, it's pretty much impossible to stamp out completely. In terms of kind of, as I said, that indirect kind of level of inadvertently submitting fraudulent documents, as you say, it's impossible to catch it out. But I'm interested from you to, firstly, is that something that concerns you? Secondly, how can you stop that? What are your main lines of defenses? Is it your own experience? Is it actual tools? Like where does it lie?
Well, I had an example last week. It wasn't fraudulent, but new client sent over documents, and I was looking at their payslip, and their year to date didn't add up. And we're not talking about add up. We're not talking about a few $100s. We're talking, it was just about 17,000. I was like, oh wow, what's going on there?
Yeah.
So I called the client, and I'm like, the client's partner, and I'm like, the person's payslips are well off, and they confirmed that they had surgery and they had unpaid leave. I got confirmation of that, showing that it was true, and then okay, cool. So you can stamp it out in those little things there, where if you're seeing $17,000 on the year to date not there, you got a question as to why. A lot of people would just get the payslip, be done with it, and off they go. So it's just, I guess, taking that extra 5-6 minutes when the documentation does come in, just to give a brief view of it, and just to sort of join the dots. Like, is their year to date correct? Does it look like it's been enhanced or anything? And especially with AI now, you just put a command into ChatGPT and it can do it for you.
Yeah.
So, listen, are we going to pick up everything? No, because in the end, we're not AI experts, or we're not like the software that can pick it up.
Yeah.
Whereas sometimes software can't even pick it up. So, is a human eye going to get every single fraudulent document? Definitely not.
Yeah.
But you can do little small steps and sort of pick out things that may look a bit unusual and question it. In my case, all right, I questioned it, and it was a legitimate reason. I got confirmation and documentation to support that as well. So that was fine. But it's going to get harder and harder.
And I guess part of it is that kind of experience, right? It's the ability for, a broker with plenty of experience to say, this doesn't smell right, let's have a look, But then on the other side, on the flip side of that, AI, tech, all these different tools are coming in, and there is potentially a minor arms race going on in terms of using detection and also using, it for malpractice as well. Is there tools on the market right now for brokers to use to try and root some of this out? Or is that something that is still in development right now?
Listen, I know the banks have some, but like we
not that I've come across. We we basically do what Costa was saying. We obviously work backwards in terms of either year to date or marry up that information with another supporting documents, just to make sure that it does it is legitimate.
Yeah.
Because at the end of the day, when we do put it forward, another bank is the lenders also potentially ask for another supporting documents. So we want to make sure that we've got something that actually, I guess, makes sense in terms of what that payslip is actually outlining to.
Yeah, absolutely. And then lastly, I guess I want to ask you guys, what are the consequences here? You know, I did ask you just quickly, like, you know, does it something you think about? And of course it is, but what are the consequences? Should you, you know, be involved in a fraudulent loan? Firstly, what are the consequences? And secondly, where do you think the kind of responsibility lies there? Obviously on the client that is submitting the fraudulent, that's a given. But past that, you know, you've got aggregators, you've got lenders, and you've got brokers. Where's the responsibility? And specifically for brokers, what are the consequences?
I guess it's a hard one because, again, speaking from a broker's perspective, you know, there's only certain things that we can pick up. And, you know, if the document's fraudulent or being made with AI or Photoshop or something, and we're not picking it up, but we're submitting it, does the responsibility come to the broker? Like, we're experts at lending money, not document reading,
exactly,
basically. So, obviously, like you said, it comes down to the actual client, first of all, because they're the ones that providing it. But, you know, I guess from an aggregated perspective, it's having systems in place. And I guess in regards to the Finni, I guess you'll have a lot of people now saying, well, they're very compliant light. So maybe that's a red flag as to why people are doing it. So they may get sort of a bit of blame going, well, you know, anyone can submit anything through you guys. That's why people are going through you. But yeah, it would be very tricky because I guess everyone would probably say this person is to blame, not me. So yeah, I guess I've never been in a situation like that, and I hope to never be. But yeah, I guess it just comes down to the client in the end. And, you know, different if it's like totally obvious, then I guess you can put some blame on the broker. But if you're talking about fraudulent documents that have been enhanced, well, you know, we're not AI professionals.
Absolutely, it's a tough one, and obviously the kind of aspects of this are yet to be fully unpacked in the real world. So we'll see where it goes. Anyway, we better take a break there. Back in a sec. Welcome back to Broker Daily Uncut. Now, as always, we like to finish off the podcast with a little bit of news around policy. Now, there's been a few interesting things here. So the main one being negative gearing and capital gains tax discounts. This is always in the news. Maybe after the budget, we can put this one to bed. But Costa, do you want to quickly unpack what's happening there?
It's looking likely that it's going to go from 50% down to 33%. That will be grandfathered. So that means if you've purchased a property before that, you will still remain at the 50% mark. Negative gearing, it's looking likely that it will be 2 negatively geared properties. Now, how that affects SMSF and all that, we don't know yet. If they're included in that too, or is it 2 personal names, stuff like that, we're not too sure of, but that is looking like it's going to come into play.
Yeah, absolutely. And something I'd noticed there is that the 2 negative geared properties, how, from your experience, obviously it's difficult to know, how many investors or property owners is that going to affect then? Is that a large segment of the market, or are most people kind of within that 2 frame? Because the investor market is so wide and diverse, right? You've got people with huge portfolios, and then you've got people that are kind of more mum and dad investors.
I would say, what would the
I'll say, well, we can't speak for all, but
for Finni,
for Finni itself, I would say at least 70% of our clients will have more than 2 properties.
Right, yeah.
And obviously there'll be other structures as well, but in talking about this, that's negative geared, it would be definitely at least 70%.
Interesting. And then on top of that, obviously, that says that the changes will be grandfathered, which means obviously none of this has kind of come in yet.
We don't know for negative gearing yet, but for CGT it will be.
So my question to that is there going to, are we going to see people kind of rushing into the market in that respect? Investors kind of trying to get one more property in. Obviously, what happens with negative gearing also matters within that conversation. Right. But is that something that, when you talk to your investor clients, is that something that comes up?
I think they probably would, because you're going to want to sort of get in there before you have to deal with it. And then you can get a property that's not going to have this negative gearing on it. Say you're at 2 properties and it's not going to be grandfathered. You're going to be like, well, might as well get that third, be able to negative gear it, and, I'm good. So you will get a lot of people in the market.
I agree, because it's a benefit now, because at the same time, if banks haven't changed their serviceability calculator,
correct,
that would also drive up the market as well in terms of getting the borrowing capacity up.
Yeah, absolutely. And something there that's quite interesting, back to negative gearing, might be this increased demand for positively geared or at least neutral areas, higher yield, different locations. Where are those locations?
You're probably looking more regional.
Yeah.
All those regional towns, larger regional towns, maybe like Nowra, Port Macquarie, Coffs Harbour in New South Wales. Geelong, maybe down in Melbourne, places like that. A lot of buyers agents are sending people down there. And listen, you may not get it positively geared off the bat, but instead of waiting 4, 5, 6 years, they're probably going for 1, 2, maybe 3 years, where they'll just have to fund it for that amount. So much less time funding it than you would have to. So, yeah.
And then kind of in terms of the long term, again, it's funny how much we're talking like this is a definite. Obviously, we're not 100% sure that this is going to happen. But obviously, it's been so much on the agenda, and I don't know how much water this leak holds, with pardon the pun. But in terms of the long term kind of repercussions, should this change go through, what do you kind of see long term for investors here?
Well, I can say for tenants that their rent's probably going to go up, because there'll probably be less investment properties, because obviously investors are the ones purchasing all those.
Great.
And if they're not buying because it's going to cost them quite a bit, well, that just means the supply pool is going to get smaller and then rent will go up. Take somewhere like Bondi, for example. There's quite a significant amount of rental properties there. And if you've got less people investing in that area and more owner-occupiers, well, the rents are obviously going to go up, supply, demand, as we all know. So, yeah, I believe that in what's it called, the rents will start going up, and you'll have investors questioning it a bit more because the gains won't be there. So they're going to be like, is it worth me doing it? Or they just, as I said before, go to regional areas.
Yeah, it could just kind of change the focus.
Yeah, because then from their point of view, is there any point of selling it as well? Because at the same time, if they're not selling, then it's going to drive up the property as well, because there's going to be a supply demand issue as well.
Yeah, and without that kind of discount, there'll be less incentive.
Yeah, and for developers, they're going to lose 17% of their profits, so that's not going to be good.
Yeah. Excellent. Well, guys, that's all we've got time for this week. Thank you so much for joining.
Thank you.
As always, Costa and Robert. Right, if anyone wants to get in touch with Finni, what's the easiest way to do so?
Finni.com.au. You can go there, click the button for book an appointment, and you'll be able to book an appointment with one of the brokers.
Ideal. And of course, as always, if you'd like to see more from Broker Daily, be it podcasts, articles, in-depth features, or news, go to brokerdaily.au. I've been your host, Julian Barnes. Thank you so much, and see you next week.
Thank you.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property, or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.